Hey everyone, today we're breaking down Lyft's recent stock drop. Over the past few weeks, Lyft shares have slid from around $19 down to roughly $14, prompting investors to ask, is this a buying opportunity or a red flag? In this video, we'll explore what the data says, how historically dips have played out, and what you should consider before investing in Lyft. In this video, we're going to break down everything you need to know about Lyft's stock dip, historical data on sharp declines, what it says about future returns, and the key principles for investing in quality stocks. We'll also touch on how portfolios can help manage risk in volatile times. By the end, you'll have a clear picture of whether adding Lyft to your watch list or even your portfolio makes sense. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. First, let's define what we mean by a sharp dip. For our purposes, a sharp dip occurs when a stock drops 30% or more in less than 30 days. Now, Lyft hasn't quite hit that threshold yet, but it's getting close. A decline of 25.5% in under a month is substantial, and for any investor, it's a signal to take a closer look. Buying on dips is a classic strategy that many long-term investors use, especially with companies that have solid fundamentals. Essentially, the idea is to take advantage of temporary market overreactions. When a stock with strong financials temporarily drops in price, it can create an opportunity to buy low and potentially benefit from a rebound. So, what makes a dip-worthy stock? A company needs to meet certain financial quality criteria. That includes healthy revenue growth, profitability, consistent cash flow, and a robust balance sheet. If a company meets these criteria, a dip in stock price might not reflect a problem in the business itself, but rather market volatility, investor sentiment, or external economic factors. Lyft appears to meet many of these essential financial quality standards. Revenue growth remains consistent, profitability metrics are solid, and the company's balance sheet is relatively healthy for a tech-based transportation business. That's an important point, because even when a stock is falling, strong fundamentals reduce the risk that the decline is signaling a long-term problem. To get a better understanding, let's look at historical performance. Lyft stock has faced sharp dips multiple times over the past decade. Since January 1st, 2010, Lyft has experienced 9 instances where the stock declined 30% or more within a 30-day period. Now, here's the interesting part. After these sharp dips, Lyft's median return over the next 12 months was 3.7%, with median peak returns hitting as high as 40%. On average, it took 96 days to reach the peak after a dip, and the median maximum drawdown within a year of the dip was 41%. What does this tell us? Simply put, past dips haven't necessarily signaled disaster. In fact, historically, the stock often recovers and even reaches new highs. While past performance is never a guarantee of future results, these patterns provide a helpful lens for evaluating current market movements. This historical data supports the idea that buying quality stocks on dips can be a profitable strategy, provided you're willing to remain patient and weather potential short-term volatility. Now, let's address another important factor: market volatility. We're currently in a period of heightened market fluctuations, and this environment impacts all stocks, including Lyft. When volatility spikes, it can amplify declines in stock prices, even for fundamentally strong companies. This is why some investors ask questions like, is this dip unique to Lyft or is it part of a broader trend? Broad market indicators, economic reports, and sector-specific factors all play a role. For example, tech and mobility stocks are often more sensitive to short-term changes in investor sentiment. For LYFT, external factors such as rising interest rates, changes in transportation demand, and competition from other ride-sharing platforms can contribute to sudden price drops. Recognizing this broader context is crucial before making any buying decisions. Now that we've talked about the dip itself and market volatility, let's return to fundamentals. When considering a stock like Lyft, we evaluate 4 key financial pillars. Revenue growth. Lyft has demonstrated consistent growth in gross revenue, indicating that demand for its services remains strong, despite market fluctuations. Profitability. While tech-based mobility platforms often face pressure on margins, Lyft's current profit metrics show that the company is operating efficiently relative to peers. Positive cash flow is vital, especially in volatile markets, because it indicates that the company can sustain operations without excessive debt or equity dilution. Balance sheet strength. A strong balance sheet helps a company withstand market stress. Lyft maintains sufficient liquidity to handle short-term challenges, which reduces the likelihood of a dip, indicating a failing business. When all four pillars are strong, the probability of a rebound after a dip increases. For investors, this combination makes Lyft an attractive candidate for a strategic buy-on-dip approach. Even with strong fundamentals and historical recovery trends, no stock is immune to risk. That's why many investors prefer to use portfolio strategies to manage exposure. A diversified portfolio allows you to benefit from gains in individual stocks while cushioning against declines. For example, the Trefis High Quality HQ portfolio, which includes a mix of 30 carefully selected stocks, has historically outperformed major benchmarks like the S&P 500, S&P Midcap, and Russell 2000. Since its inception, the HQ portfolio has achieved over 105% in cumulative returns, all while maintaining lower overall risk compared to the benchmark. The lesson here is clear. Even if you're interested in buying Lyft, it's wise to consider it as part of a broader investment strategy rather than betting everything on a single stock. Portfolios provide built-in risk management, smoothing out volatility while giving you exposure to potential gains. So, what's the takeaway for you as an investor? Recognize opportunity in dips. A 25% drop in Lyft is significant, but historical patterns suggest that quality stocks often recover. Evaluate fundamentals. Focus on revenue growth, profitability, cash flow, and balance sheet strength to distinguish temporary dips from long-term risks. Be patient. Median peak returns after dips can take around 3 months to materialize. Patience is key in investing. Diversify. Using a well-structured portfolio can protect your investments while providing the potential for higher returns. Understand market volatility. External factors like sector trends, interest rates, and competition can amplify short-term price movements. Awareness helps you make informed decisions. For those thinking specifically about Lyft, the current dip may present an opportunity to enter a fundamentally sound stock at a lower price. But always weigh it against your risk tolerance and portfolio strategy. Looking ahead, Lyft's performance will depend on several factors: user growth, profitability, competition, and the broader economic environment. If the company continues to meet quality benchmarks and the market stabilizes, history suggests the stock could recover and even exceed prior highs. Investors should also watch for any shifts in market sentiment or unexpected macroeconomic events. These could affect Lyft's stock trajectory in the short term, so staying informed is essential. To summarize, Lyft has experienced a substantial drop in stock price recently, but historical data and strong fundamentals indicate that this decline might not signal long-term trouble. Buying on dips can be a smart strategy for investors who focus on quality companies, maintain patience, and use diversified portfolios to manage risk. Remember, investing is about balancing opportunity and risk. Lyft could be a potential opportunity for those willing to navigate short-term volatility, but incorporating it into a broader strategy is the smartest approach. So, if you're considering Lyft or other tech-based mobility stocks, take the time to review fundamentals, understand historical trends, and evaluate your portfolio allocation. Doing so increases the likelihood of making informed, strategic decisions that align with your long-term financial goals. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.